We're going to start, though, with retailers. That was the story. Certainly this morning when we were on Squawk on the Street at the beginning of the trading day, the ETF that tracks the space falling nearly 2% was its worst day in more than a month as retail earnings kick into high gear. So tonight we bring you the good, the bad, and the ugly in today's... Oh, wow.
Yeah.
Got sound effects and everything here. Retail wreck. Let's start with the good. All right, TJ Maxx did manage to buck the broader trend. It closed the day in the green. This after it had a beat on both the top and the bottom line. But then there was the bad. That's Home Depot. It did get hammered. This after missing revenue expectations that also cut its 2019 sales forecast. But the ugly, that is reserved for Kohl's. The share's down 19%. It posted its worst day in more than 2 years. We should also note we just got results from Urban Outfitters. You can see it there. That stock clicking down as much as 14% in the after hours. This after reporting a miss on the top and bottom lines. So, of course, the question today is retail pain company specific, or is it telling us something about the consumer as we head into the Christmas season? Guy.
David, no. That's not how this works. If we make it to January, and I say if, because in TV, as you know, anything could happen.
Yes.
But if we make it, it's 13 years. In those 13 years, this is your maiden voyage.
Yes.
Maiden voyage on Fast Money.
It is. They never asked me. What can I say? I wanted it so badly. And I
because you're the Mount Rushmore of CNBC. I mean, you're the Clint Eastwood of the good. Of course, Joe Kernan would be the ugly, the Eli Wallach. I hope he's watching right now. I don't think it says anything about the consumer, David. I think it's company specific. I mean, on the other side of that coin, you look at a Nike that's been on fire. Lululemon continues to go higher. You mentioned TJX. That made an all-time high, 21 times forward earnings. I don't think that's ridiculously expensive. Home Depot, they had blamed strategic initiatives, but you know what? Comps missed, revenue missed. That stock looks like it wants to trade back down to the August low, which is 200. So although I would love to say it's an indictment of the consumer, I don't think it is.
Well, and if you think about Home Depot, first of all, this is a company that's trading at 22 times next year, and it had rallied significantly into this print. Their comps, actually, I don't think were as bad as people want to make them out to be. You know, ultimately, they finished October somewhere around a 5% comp. They were expected to come in for the entire quarter at 4.6, and this was far from a disaster. So I think you get to a place where think about things driving home improvement, think about refis and HELOCs and everyone, all this data we're getting coming out of a low interest rate environment. The same wind is at the back of Home Depot. You just have to question how much you want to pay for this.
Well, I'll just say this. If you're looking at the forward estimates, if I'm looking at Q4 for fiscal 2020, that's the current quarter at Home Depot, I see a down year-over-year earnings and sales print.
Listen to you.
That's the first time I've seen that in Home Depot in years, maybe 5 years. So, maybe the guidance was a little bit sandbagged. Maybe, analysts have kind of moved those estimates kind of low. But if they were to actually print their first down EPS and sales quarter year over year, that would be a seminal moment for retail, especially in this leg, especially when you consider how much heavy lifting these big cap, large cap, big box guys have done. When we think about it, what is it? It's Walmart, it's Target, it's Costco, and it's Home Depot.
Best Buy.
Kind of like my MAGA complex in tech. For all intents and purposes.
You might want to tell David what your MAGA complex
is.
David.
If you're going to be around,
it's not what you think.
That's
not what you think.
The Microsoft, the Apple, the Google, and the Amazon. We call it. I think your partner on Squawk on the Street has a FANG thing or something like that.
Yeah, he's got.
We got MAGA here.
And he has Watch also, which you just mentioned as well, which is Walmart, Amazon, Costco.
Oh, you didn't know that one yet.
Target.
You're getting the party.
Yeah, we do that one. You don't watch it?
No, but in a lot of ways, no, I do, of course. But I think it's really important when we think about retail is that we know that these mega cap big box guys are doing most of the heavy lifting, just like MAGA and tech.
But I think also there are some winners. I mean, you talked about Nike. That's obviously a very big player. But we had names like Ralph Lauren doing well. To me, the Kohl's was really the most interesting. I mean, Home Depot was priced for perfection or near perfection, and so it was only it's off 5%, and you sort of re-rate the multiple a little bit as well as the earnings being a little light. Kohl's was priced for mediocrity and missed by a fair margin. And it was hard to really get excited about some of the things that they say they're excited about. And now it trades at under 10 times earnings. I mean, and it doesn't it's cheap, but it really should be cheap.
But,
it's very
seems to be a bit of a credibility problem there. I mean, listening to the call this morning as well, they talk about the promotional environment, pricing, particularly in women's and what it means trying to establish some momentum. They did have an up quarter, at least, I mean,
Fractionally. Right, fractionally.
But not enough.
I don't know what the Amazon arrangement will do for them, actually.
It doesn't seem to be doing that much right now
I know
in terms
it's
of
early.
getting traffic in. Yeah.
They talk about they are getting traffic, and it's a different customer than than their demographic. So that's probably a good thing. But I didn't get the sense it was adding to the bottom line.
Well, David, you asked, or the question posed is there something wrong with the consumer if you look at a Kohl's and if you look at a Walmart? And the answer is absolutely not. I mean, think about, we had some housing numbers this morning reinforcing. We all know where the job market is. We know where wages are in a 3 to 4% growth. So with Kohl's, I think you get back to a case where, again, the big box stores, that's a ridiculously competitive environment. We're overstored. I mean, Walmart is finally going back to beating everybody on price. There's no margins here. The only place that they're getting growth is in terms of their grocery business. And, that's not a way to get excited. So Kohl's was the loser of this bunch at one point till it started to outperform. And I think you're going back to relative performance and relative value, where I think Kohl's stays behind those two.
Certain point, though, valuations do matter. And I don't listen. One thing I say all the time, I don't know, David, if you agree with this, but never underestimate the U.S. consumers want to spend. It doesn't mean they should be spending. So I don't want to confuse health with their want to spend. I think they're two entirely different things. I mean, I think the consumers as strapped as they've been in the last 10 years. I think consumer debt to GDP is probably north of 50%. That's unhealthy. And if you ever get a downturn in the market, they will stop spending on a dime like we saw last October, November when the market went down 20%. But in the absence of that, valuations matter. And we've talked about Costco for a while. Carter Braxton Worth, you might be familiar with his work. He's on the Parthenon of the charting business. You might be, anyway.
You might be very confused when you hear about the Parthenon.
But at any rate, back in April, he talked about Costco and the move higher, and that's exactly what's happened. But into earnings in December, Costco now at 32 times forward numbers. I mean, that's getting way ahead of its skis, I think.
Yeah, but let's separate, what the consumer might or might not do in this holiday season and what the stocks are doing. And again, last night, Gary Cohn, the former national economic advisor to Trump, he was asked a question on this program, will Trump blink if we don't have any progress on this trade deal on these consumer tariffs on December 15th. And I think that's really important. And let me tell you something. You mentioned discounting, okay? We might have an inventory issue if we saw a bunch of retailers pull forward a lot of product for the Christmas season. And then if we get to this December 15th deadline and we don't have any resolution on it and these tariffs are going in, these stocks are going down. It's that simple. Yeah. And I'll just tell you, look at the XRT. You mentioned it was down 2% on the open today. It's up 20% from a 52-week low made in August. When did that low happen? It happened after Trump mentioned the potential for these consumer tariffs. So the XRT will be going lower if these tariffs come back.
And so I would agree with that. In fact, the XRT, if you look at relative to the S&P, it's underperformed by almost 20% over the last couple of years, 15% since those lows in August of 2018. So how you're measuring the consumer in retail, though, I'm not sure it's through the XRT. Because, again, the XRT has not been the vehicle that I think has been gauging. Some of these things have been outperforming. And look at big cap tech and look at Amazon. That's really Walmart, isn't it?
Right. Now, I noticed today, Macy's and Nordstrom, your mall-based retailers in particular are the ones that they take it out on. Neither one reported a number today. We're going to hear from, I think, Macy's soon. Right. But they were down over 6% today because they're in the mall. You look at Kohl's, you wonder, and boom, they're down. Macy's, that's got to be right near a new low, right?
Macy's is now over 10% yield, which is kind of extraordinary considering, 10% yield and their debt does not trade like it's in distress at all. So there's some giant discount.
Yeah, but did you guys see Terry Lundgren, the former CEO of Macy's,
he was on
yesterday at Melissa's show? And what did he say? When he left there, he was loaded up long Macy's. That hasn't worked out well. But what did he do? He bought Walmart, Costco, and Target.
Right. He did say he had enough Macy's. He still had enough.
That worked out well.
Speaking of Walmart, by the way, and sticking with retail, we did hear from one of the world's biggest retailers, in fact, today. Walmart CEO Doug McMillon said not everything is moving 100% online. Check out what he told the panel at today's CNBC Evolve event.
I'm really confident they want stores because we're seeing the evidence of that. But a few years ago, there were a lot of voices inside the company questioning everything. And so we didn't go into it saying our purpose in life is to prove that stores are part of the future. We didn't. We started with how do customers want to be served? And it turns out that the stores end up playing a really important role in that process, especially with fresh and perishable food and things you buy in big baskets all the time.
I've made the point, Karen, in the past that he had time to fix things at Walmart because he's got the family in there as the very large shareholder. He doesn't have to worry about anybody else coming in there and pressuring him. And they've done a lot there in terms of online, obviously, the Jet acquisition and then moving from there, and in the stores as well.
I was skeptical of the Jet acquisition when they did it and their whole push. And I mean, they were buying everything. They bought, was it Bonobos or
Flipkart
right?
too?
They were, they were just
whatever that means for them.
I don't even know, buying willy-nilly, but he really has done an extraordinary job. He also had a lot of money to be able to do it. I mean, they're really competing head-to-head. And, I mean, they seem to have great momentum. The stock's a little bit expensive. I own Target. It's hopefully on the same trajectory, but just a little more
the best thing
priced.
The best thing that ever happened to the stock, though, is that they threw their hat in a big way into online. And they had to, but they're almost getting some bit of an Amazon multiple. They're not even close. But I'm saying, to get the benefit of, hey, we're in a growth part of our business, and relative to our core business, this is showing 30% growth. That's something that the stock has been rewarded on. But I would repeat that Walmart's growth in groceries, which is a losing business for them, it's getting people into the stores, and that's great. But in terms of comps, it's not really pushing them over the edge.
Real quick, though, 6% earnings growth in Walmart with a 23 forward doesn't make sense. Now, you can say that for the last $20 in the stock, and you've obviously been wrong. At a certain point, it matters. Target tomorrow might be the tell on the consumer.
Listen, I don't know how you're going to have this conversation and not mention the fact that Amazon is down 13% from its 52-week highs made over the summer. When you think of the rest of the MAGA complex all trading at new all-time highs just this week alone, I just think that's pretty interesting.
For what? No, I mean,
for the rest of retail,
what's that telling you?
because Amazon was that darling. They were the ones forcing the change over at Walmart, over at Target. And to your point before, as AWS becomes a smaller percentage of their sales, they're relying on just what they can do, how they can flex in retail. And we know that one-day shipping has been a tax in this company.
Well, they're spending a lot of money, right? They're in an investment cycle again, which investors sort of.
Yeah, well, they're in the penalty box for now.
Yeah.
Yeah.
The multiple divergent guy is interesting, though, in retail. I mean, Kohl's at 10 times, Costco at 32 times, Walmart at what you said, 23 times.
Yeah, 23 times. I mean, Target actually is the one that makes...
But what are you supposed to do? The higher multiple stocks are the ones you want to seemingly own.
Yeah. Until you don't. And you know how fast things... I mean, you could say this. Remember Under Armour, everybody wanted to own it at a certain multiple. Then it stopped on a dime. I mean, when multiples matter is when you got to get out of the way because things go a lot further down than people give them credit for, in my opinion.